I'm Wendy Gillette with Small Cap Nation, joining you today from the NASDAQ market site here in Times Square. And joining me is Rod Turner, who is the CEO and founder of Manhattan Street Capital. Thanks so much for being with us.
Thank you for having me.
Tell me about the company.
We are a funding platform. We help companies raise capital using Regulation A+, companies that are a little bit further established than startups that need to raise $4 to $50 million per year is the option by selling shares to anyone worldwide.
Why do you center on those types of companies with those revenues between 4 and 60, 50, 60?
Because Regulation A+ will over time build to be a very large business, in my belief, and based on all the metrics and research that we've done. And the companies that fit that model are more established. That size of capital raise suits this mid-sized company group that haven't had access to sizable growth capital for a very long time. And now they can be a private company, sell their shares to the public, promote themselves, build their brand, and this is going to be a giant segment. It's going to be really big. So focusing on it is the best thing to do. It's a unique and rather specialized space. And your company's making a big announcement this week. Tell me about that. Yes, we're very pleased to announce that our first company offering is going live actually right now. The company is called Blue Marble Biomaterials. And this for us is a milestone event because we have 1,400 company members, of which I've spoken to 300 in order to help them figure out if Regulation A+ fits their capital raising goals. And this is the first one that has come through our system. And why is it not right for some companies? The biggest challenge tends to be once the fundamentals are there, that's the strength of the team and being in a real business with strong industry trends, then the challenge that still remains is that the company today, to succeed in Regulation A+, it must appeal strongly to consumers. Consumers are the ones that make or break Regulation A+ equity crowdfunding offerings at this stage in the game. Gradually it'll broaden out, but the funding window is limited by that characteristic. Let's talk about the types of equity crowdfunding. Yes, so one type is, for 3.5 years, Title II has been in existence where wealthy investors could buy into private companies and have no liquidity afterwards until those companies succeeded. That's good. It's been doing well. It's probably $3 billion a year of capital raised right now. Regulation CF, Reg CF for short, regulation crowdfunding. Up to $1 million of seed capital can be raised from investors of anywhere in the world of any wealth level, which is a very big plus, with no liquidity, but that's appropriate for early stage companies. That's a great option. Title IV, Regulation A+, is the biggest one in terms of the size of the group of companies that it serves. So companies in the US and Canada, there are about 1 million companies in that space that are mid-sized that need growth capital, or might need growth capital, I should say. So probably within 4 or 5 years, Regulation A+ will become the largest of those groups. I'm estimating $50 billion a year of capital raised for the whole of the Regulation A+ segment. And you have a unique position in terms of giving advice to these companies. You've been a CEO or a chairman of companies basically since you got out of university. You've handled a lot of acquisitions. Tell me more about your background. So I have had a lot of good fortune, and I've worked my buns off along the way too, as I continue to do. And so I got into startup companies at a relatively tender age. My first IPO was a company called Ashton Tate. We went public in 1983. So how old were you then? I was 26, I think. Yes. Young, youngin'. Yes. So that was good fun. And I was vice president of sales, under the gun to make the numbers happen. And then Symantec was my second IPO, so that was great experience. So I've been able to build upon my engineering background into general management, and the acquisitions that I've been involved with, especially at Symantec, where the acquisition of the Peter Norton utility company, that really became Symantec, and that was a very fun transaction. It's easy to buy companies, it's easy to target companies to buy. The execution of a successful merger is challenging, and we did a really good job at Symantec of making those mergers work well. So how does your background help you when you're talking to other CEOs of companies? I think it gives me some credibility, so they'll pay attention, which helps a great deal. I've also done my own venture capital firm with a very close friend of mine. So the credibility does help. But mostly, though, I can generally fairly quickly ascertain the companies, determine which companies have what it takes to be long-term successful entities when the characteristics of the management team are right, when the segment, the business they're focused on is likely to become, to be a very long-term successful segment versus fighting a trend, you know, having the trends favor them. So I have the advantage of having done a lot of this stuff. So,
how is Manhattan Street Capital different from its competitors?
I would say perhaps we are more thorough in our approach, perhaps more selective in the companies that we will work with. But I give credit to our competitors. There's some great companies out there, and we're really all learning the ropes. I hope and believe that we are leveraging my experience and those of my team members to reduce the number of mistakes that we make. But this is early days for this whole industry. It's very early days. So one has to be patient and recognize that there's these overnight successes, they take a long time to make happen, you know.
And 2017 Trump presidency, how do you think that is going to affect the industry?
I think over time, because these things will take a little time, we'll probably see significant improvements in the flexibility that we'll have, especially in Regulation A+, because we're taking companies public, the regulatory environment has to be and is very restrictive, appropriately. I believe we'll see that situation become more flexible, and that'll make it possible for more companies to utilize these methods.
All right. Sounds like it's going to be very exciting next year for you.
Yes, I think so.
Okay. Thanks so much for joining us.
Thank you.
And you can join us on smallcapnation.com for more stories. I'm Wendy Gillette with Small Cap Nation.